Welcome back to Talk Tickers. You know the drill by now. We strip mine earnings calls for alpha and leave the corporate fluff on the cutting room floor. I'm your host, and today we are heading north. Way north. We are looking at a company that sits dead center in the energy patch, battling frozen pipes, skeptical investors, and, well, a market that doesn't quite know what to do with it.
That's right.
You're digging into Hess Midstream, ticker symbol HESM.
It is good to be back. And honestly, this deep dive is a fascinating psychological study. We're looking at a classic battle of narratives here.
How so?
On one side, you have a messy quarter missed revenue, weather problems, the stock taking a hit. On the other side, management is basically popping champagne, claiming they've finished their chores, built the house, and are ready to just sit back and print cash for the next 3 years.
That's the tension, right? The jam tomorrow promise versus the no jam today reality.
Exactly.
And looking at the tape, the market clearly fixated on the no jam today part. The stock closed down 1.41% to $34.97 on the day of the call.
Yeah, it popped in the morning, but then the skepticism just set in and the tape faded hard.
So our mission today is to figure out if the street is wrong to give them the cold shoulder, or if this is, a value trap in disguise. Let's start with the damage report. How bad was the quarter, really?
It wasn't a disaster, but it was annoying. I think that's the best word for it. If you just look at the bottom line, GAAP earnings per share came in at 7.72 cents. That was effectively in line with the street, where estimates were hovering between $0.72 and 73 cents.
Right.
So no major alarm bells on the accounting profit.
Sure, but let's be honest. Earnings per share can be engineered. You can tweak depreciation schedules. You can buy back shares to boost the ratio. Revenue is the truth serum. Do they move the product or not?
And that is where the pain point was. Revenue came in at $404.2 million. The consensus was looking for $417.05 million.
Okay, so a $13 million miss on a $400 million quarter. That's roughly a 3% miss. I mean, in the grand scheme of things, that doesn't sound apocalyptic. Why did the market choke on that?
Because when you are a midstream company, essentially a toll road for energy, you are priced for stability.
Right, for perfection.
For perfection. A $13 million hole in the top line signals that the toll road had less traffic than expected. And for investors seeking safety, that uncertainty is toxic.
Okay, let's look at the cash flow, because that's the holy grail here. Dividends don't get paid out of revenue, they get paid out of free cash flow. Where did they land?
Adjusted EBITDA hit $309.1 million, and adjusted free cash flow was $207.8 million.
So healthy numbers.
Healthy numbers in a vacuum. In fact, they felt confident enough to raise the Q4 distribution to roughly $0.76 per unit. So despite the operational hiccups, they are paying you to wait.
But the stock still dropped 50 cents on heavy volume. About 2.5 million shares traded. It feels like the market looked at that revenue miss and got nervous at the growth story. But here is where we need to pivot. Because the management team spent almost the entire call trying to ignore Q4 and point at 2026. They are calling it a pivot year.
That is the core thesis here. If you are listening to this and you hold HESM or you're thinking about it, this is the one thing you need to understand. The structural story of Hess Midstream has changed.
How so?
They are declaring that the infrastructure buildout is done, finished.
Done is a very powerful word in the energy sector.
It is.
Usually these companies are on a treadmill of endless spending. Drill more wells, build more pipes to serve the wells, repeat.
Not here, not anymore. This is the most critical takeaway from the sources we analyzed. Look at the capex guidance capital expenditures. For 2026, they are guiding to approximately $150 million.
And that's down from?
That is a 40% reduction compared to 2025. But it gets even more dramatic when you look out at the 2027 and 2028 outlook.
Lay it on us. How low does it go?
They expect capital expenditures to drop to less than $75 million per year.
Less than $75 million. For a company with a market cap over $3 billion, that is pennies.
Yeah.
That's just painting the pipes and mowing the grass money.
That's it.
That barely covers maintenance, surely.
That is exactly the point. We are seeing a switch from construction mode to ATM mode. Think about it like building a massive apartment complex. For years, you are pouring money into contractors, lumber, plumbing. You're cash flow negative.
Right.
But then the building is finished. The contractors leave. You put tenants in. Suddenly, your expenses drop to near zero. But the rent checks keep coming.
So they're saying the complex is built.
Yes. They even highlighted a specific operational detail. a new compressor station, about 50 million cubic feet per day of capacity, just went into service in January 2026.
Okay.
Management framed this as the last big piece of the puzzle.
And because the spending is crashing, the free cash flow is set to explode.
Precisely. They're guiding for $850 million to $900 million in adjusted free cash flow for 2026. That is a 12% increase year over year. And this is key. It's not coming from a huge spike in oil prices or some massive new discovery. It's coming simply from stopping the spending.
It is capital discipline driving yield. That sounds great on paper, but, and there was always a but with these stocks, if the house is built, why was the rent check light this quarter? We have to talk about the villain of the quarter.
The weather.
It always sounds like the dog ate my homework, doesn't it? Ooh, it's too cold in North Dakota. It's North Dakota. It's always cold.
Right.
Why does this still surprise them? Why aren't they prepared for winter in the one place they operate?
Well, to be fair, the Bakken region is extreme. We aren't talking about needing a jacket. We are talking about wellheads freezing off and trucks being unable to drive on icy roads because it's 40 below zero.
Okay, fair enough.
So management attributed the revenue miss and the volume drop almost entirely to severe winter weather. Throughput was down year over year across the board.
Break down throughput for us. What exactly wasn't moving?
Everything. Oil terminaling was down 4%.
Pause there. Terminaling. That's just storage and moving oil from one tank to another, right?
Essentially, yes. It's the logistics fee for handling the crude oil before it goes into a long-haul pipeline or a rail car. If the oil doesn't show up because the well is frozen, you don't get the fee.
Got it.
Gas processing was down 1%, and water gathering took a 5% hit.
Water gathering down 5% seems significant. That's the dirty water that comes up with the oil, right?
Correct. It's a byproduct. If you aren't producing oil, you aren't producing water, so you aren't paying Hess Midstream to dispose of it. And it wasn't just December. They threw some cold water pun intended on the current quarter, too.
Right. They warned that January and February 2026 were also brutal.
Exactly. So they're already signaling that Q1 volumes are going to be soft. This is a recurring toll road risk. If the cars, in this case, the oil and gas can't get on the road because the on-ramp is frozen, you don't collect the toll.
So if I'm a listener holding this stock, I'm thinking, great, my dividends depend on a thermometer. Is this a systemic issue or just bad luck?
It is a systemic geographic risk, yes. But management was keen to point out that they expect a seasonal recovery in the second half of the year.
Right.
It's a pattern we see often in the Bakken. Q1 is messy, Q2 stabilizes, and Q3 and Q4 are where they make up the ground.
But that brings up a massive safety question. If volumes drop, does the cash flow drop proportionally? Because if my dividend is funded by cash flow and cash flow is frozen, I'm in trouble.
That leads us right into the safety net, because usually if you run a toll road and no cars drive on it, you go broke. But Hess Midstream has a special kind of insurance policy called minimum volume commitments, or MVCs.
Okay, let's break this down for the listener who isn't a contract lawyer. ELI 5. What exactly is an MVC?
Think of it like a gym membership. You sign a contract with the gym to pay $50 a month, whether you go or not.
Okay.
The gym represents Hess Midstream. You represent the oil producer. Even if you stay home on the couch for a month because it's snowing, meaning no oil flows, you still have to send that $50 check to the gym.
So it decouples the financial performance from the physical activity.
Exactly. And they revealed a staggering stat on the call. 95% of their 2026 revenues are protected by MVCs.
95%. Wait, let me play devil's advocate here. I'm looking at the numbers. If 95% of the revenue is guaranteed, like a gym membership, why did they miss revenue by $13 million? Why didn't the MVCs save the quarter?
That is the million-dollar question, and it's where the nuance lives. The MVCs protect the floor, the base membership fee, but midstream companies often make extra money on uncommitted volumes. Going back to the gym analogy, the $50 is guaranteed, but usually when you go to the gym, you also buy a smoothie and a protein bar. That's the uncommitted revenue.
Got it.
When you don't show up because of the snow, the gym still gets the $50, but they lose the smoothie sales.
So the miss was the lack of smoothies?
Exactly. The bonus volumes evaporated.
Yeah.
Also, there is sometimes a timing lag on deficiency payments. That's the check the producer writes when they miss the volume target. Sometimes that check doesn't clear until the next quarter, so it looks like a revenue miss today, but the cash catches up later.
Got it. So the MVC protects the dividend, but it doesn't protect you from missing the upside estimates that Wall Street models.
Correct. But for a dividend investor, the protection is the priority. The check is in the mail regardless of whether the oil physically moves. This is why the expert consensus, and why we are seeing analysts hold steady, is that the dividend is safe.
Right.
The market might react to the headline volume miss, but the cash flow floor is contractually guaranteed.
That is a huge distinction. The market sees revenue miss and sells. The insider sees MVC protection and buys.
And there is another layer of protection here, inflation. Their tariffs aren't static. They have inflation escalators built into these contracts. So as costs rise, or simply as time goes on, the fees they charge go up. This helps offset lower physical volumes.
And a very robust defensive structure.
It is.
Okay, so let's zoom out. We have a company that has stopped spending money on building, has 95% of its revenue guaranteed, and is about to generate nearly $1 billion in free cash flow. Sounds like a lot of cash sloshing around. What do they do with it? Are they going to buy a competitor? Build a golden pipeline?
No, and this is key to the Blinkist summary of this company. They are not looking to expand. The strategy is purely deleveraging and buybacks.
Boring but responsible.
Extremely. Their debt is currently at about 3.1 times EBITDA. They plan to use that excess cash, about $210 million left over after dividends in 2026, to pay down debt, letting their leverage ratio drift naturally below 3.0x.
But why not grow? Why not build more? I mean, usually if you have cash, you try to get bigger.
To answer that, you have to look at the puppet master. You have to look at the Chevron angle.
Right, the merger. Chevron is the parent company now. They own about 37.9% of Hess Midstream following their acquisition of Hess Corporation.
And Chevron's strategy for the Bakken is very different from the drill baby drill days of the shale boom. Chevron has explicitly stated a goal to plateau production at roughly 200,000 barrels per day. They are in maintain and harvest mode.
So Hess Midstream's strategy is just a mirror image of Chevron's strategy. Chevron says we aren't growing production, so Hess Midstream says we aren't building more pipes.
Exactly. It's perfect alignment. Why would Hess Midstream build a new pipe if their biggest customer, their parent company, isn't going to fill it?
Right.
But this brings us to the investor context. Because if you are a growth investor, this sounds terrible. No growth, flat volumes. That's why the stock has underperformed.
Yeah, let's look at the scoreboard. It hasn't been pretty. Over the last year, HESM is down about 14%. Compare that to the sector ETF, the AMLP, which is up almost 6%. They are lagging the pack significantly.
And that lag is driving sentiment. Raymond James actually downgraded them to market perform back in January. Their reasoning was exactly what we just discussed, muted growth. They see a flat earnings trajectory for 2026 and 2027.
So we have this tension. On one hand, the bull case says you own a bond proxy. You have a 95% protected revenue stream. Costs are dropping off a cliff because capex is zero and cash flow is rising. It's a safe, high-yield place to park money. It's a value vault.
Right. But the bear case says there is no growth left. The party is over. The buildout is done. Volumes are flat or weather dependent. And the stock is dead money compared to the broader market.
And the revenue miss just reinforces that fear.
It reinforces the fear that this is a no-growth story, absolutely.
It's the difference between buying a tech startup and buying a utility company. But HESM is priced like a midstream company, and maybe it should be priced more like a high-yield bond.
That is a fair assessment. The market is struggling to categorize it right now. Is it a growth company that failed or a cash cow that is succeeding?
The earnings call was them trying to scream, we're a cash cow.
Exactly. But the market was still looking for growth metrics.
Speaking of screaming, I think it's time to upset our legal department.
Oh boy. Here we go.
It is time for our This Is Not Financial Advice segment. The legal team is currently hyperventilating in the corner, but we're going to pitch a trade idea that is wild, plausible, and definitely not financial advice.
Please proceed with caution.
Do not do this. We are just two voices in your headphones. Okay, I call this the Chevron piggy bank play. It's a leveraged bet on a take-private scenario.
I'm listening. Walk me through the logic.
Okay, look at the pieces on the board. 1, HESM is finished building all the expensive stuff. The heavy lifting is done. CapEx is dropping to $75 million.
Right.
2, the stock is lagging the sector down 14%, so it's cheap relative to its peers. 3, Chevron owns the upstream, the oil, and they effectively control the midstream, the pipes.
I see where you're going.
Why would Chevron, one of the biggest, most cash-rich companies on earth, let public shareholders keep collecting that rising 12% free cash flow yield? Why let us keep the $210 million in excess cash?
It's the ultimate thanks for building our house, now get out scenario.
Exactly. The public markets funded the infrastructure build-out. Now the infrastructure is built. Chevron doesn't need our capital anymore. They don't need to issue shares to build pipes because the pipes are in the ground.
So the thesis is that Chevron rolls up the minority interest.
Yes. They buy out the public float at a premium to stop leaking cash to public unit holders. It cleans up their corporate structure, and they capture 100% of that free cash flow for themselves.
It makes strategic sense. Chevron is in harvest mode. Why share the harvest? And historically, we've seen this happen with other midstream MLPs once the growth phase ends.
Right.
When the capex drops to zero, the parent company usually swoops in.
Precisely. So the trade is you go long HESM, but you juice it. You buy out of the money calls for late 2026. You are betting that sometime in the next 18 months, Chevron looks at the spreadsheet and says, it's cheaper to buy them now than to pay them dividends forever.
It is a compelling narrative. The lack of growth projects actually supports the take-private thesis because there is no complexity left. It's just a cash machine.
And big oil loves owning 100% of its cash machines.
They do.
Exactly. It's a boring company that could have an explosive exit.
Yeah.
Again, not financial advice, but if I were sitting in a boardroom at Chevron, I'd be looking at that stock price drop and licking my chops.
It certainly adds a layer of intrigue to what was otherwise a very weather-focused earnings call.
So let's wrap this up. What is the final verdict for the listener today?
If we zoom out, we are looking at a company in transition. The Q4 results were messy, yes. The revenue miss was real, and the weather in the Bakken is a persistent nuisance that isn't going away.
But the capex crash is the real story.
It is. We are moving from the messy construction phase to the clean operational phase. The question for the investor is, do you believe the free cash flow guidance?
Correct.
If you do, the 1.41% drop and the 14% lag over the last year is an opportunity to buy a secure yield at a discount. If you believe the weather issues are going to persist and that no growth means value trap, then you stay away.
It really comes down to whether you want to own a growth trap or a value vault. The weather will clear up eventually. Spring comes to North Dakota, but the lack of growth projects is permanent. And for some, specifically those looking for income, that lack of spending is a feature, not a bug.
Well put.
All right, that's a wrap on this deep dive into Hess Midstream. Thanks for listening to Talk Tickers. Do your own diligence. Don't blame us if you lose money on frozen pipes or wild option bets. And we'll see you on the next deep dive.
Stay warm out there.